going to give a presentation on risk measures comparison. We will present our findings through an empirical study on the Hong Kong market after introducing the theoretical part of the risk measures. Let us take a look at today's agenda. First, we will talk about our motivation for conducting such a study. In order to let you have a better understanding of different risk measures, we will give some basic ideas and highlight the main concepts on each of the measures. Afterwards, we will present two papers which we have mainly studied in over the past months. The first one is the mean absolute deviation portfolio optimization model and its applications to Tokyo stock market, which is written in 1991. The second one is the portfolio optimization with conditional value at risk, objective, and constraints, written in 2002. These two papers give us some brief ideas on some commonly used risk measure and give us the background in doing our empirical study. We replicated and applied the methodologies to the Hong Kong stock market in this next session and further extended the results through portfolio performance evaluation and portfolio variation. At the end, we will draw a conclusion on our findings and show a list of references which we have used in our study.
Very often, retail investors like to invest in the stock market to enjoy the high stocks return. Assume one can define how much he is willing to pay for his initial capital investment and he has a fixed target return. We believe these assumptions are realistic since an investor should know his initial investment amount or maximum amount of capital he can afford to lose. At the same time, there is a certain objective for investor to achieve through the stock investment. For example, an investor may have a subjective target return or has to fulfill certain future payment obligation. More commonly, an investor would like to beat a benchmark return, such as the market index return. All these common objectives allows us to fix a target return for the investment in our following studies. On the other hand, many investors do not have a preferred risk management tool. It can be hard to think of the most suitable risk management tools for an individual investor. More importantly, is there any difference in terms of the portfolio construction or the portfolio performance with different risk management tools used or risk aversion? The next question we have to ask is that how do we do the comparison between different risk measures which can be used in portfolio construction? Even if we know there is difference in using different risk measures as tools, we have to find some ways to define them clearly. The papers introduce two possible methods, including the portfolio weights and the portfolio performance. In terms of portfolio weights, the risk measures can be compared by looking at the weights of different stocks in the portfolios. For portfolio performance, we can compare the outsample return for portfolios formed under the minimization of different risk measures. Note that in this presentation, all the returns calculated are simple return, meaning that the returns are calculated as the percentage change in stock price from one period to another period. We move on to talk about the meaning of different risk measures. The volatility of return is defined as the dispersion of return of any given portfolios. Higher volatility is considered to be more risky since returns experience a larger fluctuation and is more unpredictable. In terms of computation, volatility can be estimated from the formula in the slide. Next, we introduce the market risk model, which is a popular model in modern portfolio theory. It studies the return, correlation, and diversification on probable investment portfolio returns. The detailed computation is as follows. Suppose there are n stocks or n assets in the universe, which we are interested in. The portfolio return can be computed as the weighted average of these stock returns, where the weight depends on how much we invest in each of the stocks. For the portfolio variance, note that there are correlations between security pairs, and the variance should equal the sum of individual stock variance and covariance between different assets. We know that portfolio variance can be reduced by choosing different assets with low or negative correlation. This type of diversification is used to reduce risk. The market risk model is indeed an optimization problem, which investors would like to minimize the portfolio risk subject to certain target return. We also set constraints on the sum of weights equals to 1, which means that investors have to fully utilize their investment capital in stock investment and cannot hold any cash. Note that short selling is allowed in the original market risk model. From the graph, the shaded area refers to the possible combination of return and volatility through different stock weightings. The minimum variant portfolio refers to the portfolio which meets the fixed target return but of the smallest volatility. Then, we introduce the mean absolute deviation, which is another measure of measuring portfolio risk. The mean absolute deviation is defined as the deviation of return from its mean return of any given portfolios. It can be computed as the average of absolute deviation of returns from its mean return. It also measures the dispersion of return, which makes it comparable to the volatility measure. We can say that more dispersed return implies a higher volatility and a higher mean absolute deviation. Next, we introduce the value at risk and the conditional value at risk. Value at risk cares about the percentile of the loss distribution. For a given confidence level alpha, value at risk refers to the smallest amount of money such that the probability of losing less than or equal to it is alpha. It can be shown in the graph. Assume we know the return distribution of an asset, and we would like to find out the 95% value at risk. It means finding the amount of loss such that there is at most 5% chance losing a larger sum of money. For conditional value at risk, it cares more about the tail distribution. Previously, we talked about how to measure value at risk. Conditional value at risk is the weighted mean of value at risk and the losses strictly greater than value at risk. We can consider it as the expected loss conditional on the loss exceeding the value at risk level. In short, we can consider value at risk as VAR and the conditional value at risk for CVAR. And we can expect that CVAR to be a greater amount than the VAR at the same confidence interval. The last risk measures we will use in this paper is the single factor model. It aims to measure the asset risk by measuring the correlation between the asset return and the factor return. It is common to choose the market index as the factor, and we can estimate the parameters alpha and beta for the model through regressing stock return against the market index return. The portfolio total risk can be easily derived through simple algebra. We denote the weight on each asset by X and the asset return by R. We can show that the portfolio variance can be decomposed into the systematic risk and the idiosyncratic risk. By choosing a larger number of stocks or stocks with low correlation, we will be able to diversify the idiosyncratic risk. However, we cannot diversify the systematic risk, which is something affecting all the stocks in the market. We present two papers here. The first one being the mean absolute deviation portfolio optimization model and its application to Tokyo stock markets, written in 1991. The paper addressed the issue of computational difficulty associated with the large-scale quadratic programming. Here, quadratic programming means the objective function to be maximized or minimized is a quadratic subject to some linear constraints on these variables. Previously, we have talked about the Markowitz model, which is a quadratic programming problem. In case of larger number of assets, the quadratic programming can be problematic, even with the computers nowadays. It means that the classical Markowitz model is not practical in terms of the computational time in reality, even if it is a good model in terms of risk diversification or portfolio construction. In this paper, the author proposed the use of piecewise linear risk function to tackle the issue. Piecewise linear risk function means that the risk function is linear in different segments. Using such function allows us to solve a linear program instead of a quadratic program. The change in risk measure from mean variance to mean absolute deviation leads to a portfolio optimization problem using the L1 risk, where the L1 risk is defined as a linear risk function. The paper shows that the optimal portfolios formed under the Markowitz model and the mean absolute deviation model are similar, but they are significantly different from the index model. However, the computational time of mean absolute deviation model is much shorter than that of the mean variance model. In this paper, the author used the Nikkei 225 index constituents as of 1980 for the portfolio construction, and the Nikkei index as the factor for the single factor model. The author tested his findings in 3 periods, namely D1, D2, and D3, and the details are specified in the slide. 5 years of data were used for portfolio construction, and the year after was used as portfolio performance evaluation. Unfortunately, we are not able to find the Nikkei constituents as of 1980, and therefore, the results presented in the following slides are based on Nikkei constituents as of 2009, which is the earliest date available in Bloomberg. We used the index constituents as of 2009 and find the price data of these stocks for D1, D2, and D3. Obviously, there were some stocks which did not exist in 1980s but appeared in the index constituents in 2009. In this case, we only use the stock which exists in both 1980s and 2009, and any dates with price not applicable are deleted. We also restricted to the investment environment with no short sale, since it is somehow difficult for an individual investor to short a single stock in reality. The paper gave a review on the Markowitz model, and we quickly highlight some important issues stated in the paper. Regarding this model, it is assumed that the stock returns follow the multivariate normal distribution, and the investor is risk-averse in the sense that they prefer a lower standard deviation of return to a higher standard deviation. There are a number of limitations using this model. First, the computational burden is very high, especially when we expand our possible stock choices. Consider there are 100 stocks to choose by an investor. The first step an investor has to do is to estimate the 100 by 100 covariance matrix, which is already troublesome and subject to a lot of measurement error, let alone the quadratic programming problem. Another major issue is that the investor's perception against risk and the stock price's distribution. If investors does not think that the stock price does not follow multivariate normal distribution, the model does not work properly. Another issue is the transaction cost and the cutoff effect. Very often, the Markowitz model results in insignificant amount of capital invested in some of the stocks, which is not feasible in practice. The problem can be solved using mean absolute deviation model, where integer programming can be incorporated to account for the insignificant capital investment in certain stocks. Now, we introduce the mean absolute deviation model, which is a kind of L1 risk model. The portfolio construction under this model can be formulated as follows. We would like to minimize the mean absolute deviation function, which is Wx, subject to three constraints, including a target return, the capital being fully utilized, and no short sale. The optimization problem is similar to the one in Markov risk model, except the minimization of the risk function. In this paper, the author proves that the portfolio weights constructed under the mean variance framework is equivalent to the weights constructed under the mean absolute deviation model, given that the returns following multivariate normal distribution. The proof involves some basic calculus and is straightforward. It means that we can prove the optimization problem under the mean variance model can be transformed into a L1 risk minimization problem. In practice, the mean absolute deviation model can be implemented as follows. First, we determine the length of historical data we would like to use for portfolio construction, and we denote it by T. The realized return of a single stock can be computed as the simple average of the simple return over the past T period. Then, we can approximate the mean absolute deviation function by plugging in the realized return and the average return. It leads to an optimization problem which is more down to the earth and is somehow solvable using Excel solver. However, as we can see, the absolute sign makes the objective function a bit troublesome, and actually the problem cannot be solved directly using Excel or R if the number of stock is greater than 200. Excel solver has an upper limit of 200 variables, and higher number of variables required another paid version of Excel, which is not available to most people. To tackle the issue, we have to transform the optimization problem into a dual problem. We remove the absolute sign in the objective function by introducing a dummy variable y and set some additional constraints on y as to cater for the original absolute sign. Other constraints remain unchanged. This optimization problem can be solved using R regardless of the number of stocks. We move on to discuss some benefits of using this L1 risk model. There are a number of advantages of using this L1 risk model instead of the L2 risk model. First, we can avoid estimating the dense covariance matrix. For mean variance framework, we need to estimate the covariance matrix before getting into the quadratic programming problem. For mean absolute deviation model, we can directly use the deviated return as an input to the model for the optimization problem, which is more convenient and subject to less measurement error. Second, the number of functional constraints remains constant for the L1 risk model, which means it is independent of the number of stock choices. In this case, we can control our number of stocks in the portfolio to T, and it is easier for us to use the integer linear programming techniques to avoid the cutoff effect mentioned earlier. In the next section of the paper, the author compared Sharpe's single factor model with the L1 risk model and the Markov risk model. Recall that the Sharpe's single factor model relates the return of a single stock to a common factor. The parameters alpha and beta can be estimated through regressing the stock return against the market index return. Sharpe claimed that there can be a reduction in computational time from Markov risk model to the single factor model due to the diagonal expression of the portfolio variance. We have shown in the introduction session that minimizing the risk of the single factor model is the same as minimizing the systematic risk of a portfolio. We produce the efficient frontier for all the three models under D1 period, and we can observe that there is no significant difference in terms of portfolio return and portfolio variance for the three models. Note that the graph plots the volatility against return, which is not commonly seen in the finance textbooks. Although there is no significant difference for the shape of the efficient frontier for the three models, we are able to spot some differences in terms of portfolio constituents. In this table, we have shown the optimal portfolios for the three models under each of the period. We can see that the mean absolute deviation model is quite similar to the market risk model over all the items in the table. For example, under the D1 period, the number of stocks in the mean absolute deviation model is 31, while that in the market risk model is 32. For both models, there are around 20 stocks with positive weights less than 3%, which sounds reasonable for a diversified portfolio. On the other hand, we can take a look at the single factor model, which is the third column under each of the period. We can observe that the number of stocks in the single factor model is significantly larger than the other two portfolios, and the stock with the maximum share only accounts for 5% of the portfolio. There are a total of 66 stocks with positive weights less than 3%, which is somehow not practical for a retail investor with limited capital. We can observe similar patterns for the model in the other two periods. In the next page, we showed the portfolio value over the outsample period for all the three models together with the two indexes. We can see that the single factor model outperforms the others quite significantly, and the mean absolute deviation ranks second in terms of the portfolio value. The portfolio return is shown in the next page. In general, the single factor model and the mean absolute deviation model enjoys higher return than the index when the market is performing well and suffer from smaller loss when the market is down. It makes both models a good choice in terms of the portfolio return or the portfolio value. In conclusion, the author was able to draw comparisons between the mean absolute deviation model, the market risk model, and the single factor model. Using the Nikkei constituents as of 1980s as data, he concluded that the mean absolute deviation model is better than the market risk model in terms of the computational time and in terms of the outsample portfolio return and the cutoff effect. Comparing the mean absolute deviation model and the single factor model, they generate similar outsample return, but the single factor model requires a lot more number of stocks to achieve such a performance and is not recommended for retail investors.
We're going to present the second paper, Portfolio Optimization with Conditional Value at Risk Objective and Constraints in 2002. This paper introduced portfolio optimization under CVAR constraint and extended the traditional approach to other classes of problems with CVAR functions. Why the authors considered CVAR instead of VAR? First, let us look at the properties of VAR. VAR is a popular quantile measure for risk management. It is easy to understand the representation of high losses, and it can be efficiently estimated when underlying risk factor follows normal distribution. However, it lacks of subadditivity when the underlying risk factor does not follow normal distribution. It means that VAR of a portfolio with two instruments greater than the sum of individual VARs. It is also difficult to optimize for discrete distribution, especially using scenarios. It is non-convex, non-smooth as a function of position, and has multiple local extrema. Next, we look at CVAR. The paper suggested that CVAR can be a supplement or even alternative to VAR because it is similar to VAR. It has more attractive properties than VAR, like subadditivity, convex, and coherence. It is proven that linear programming can be a tool for CVAR optimization. Now, we take a look on the definition of linear programming. Linear programming means that we try to find x1 to xn so as to maximize or minimize the linear objective functions subject to linear inequality and equality constraints. In the slide, summation CIXI is the objective function. There are p greater than constraint, q less than constraint, and r equality constraints. Later on, we will see linear programming plays an important role in solving the optimization problem. Traditionally, CVAR optimization problem is to minimize CVAR by specifying a target return. In this paper, it extends to other problems. It maximizes the reward function like expected return under CVAR constraints. It imposes CVAR constraints according to preferences of decision maker in terms of utility by specifying the percentage of the initial portfolio allowed for risk exposure. It also includes transaction costs, constraint in each position, and position changes, etc. This session is about some mathematical definition and notation. Small x is a portfolio in big X, which is the set of available portfolios. Y is a random vector with probability distribution P of y. F of x and y is defined as the portfolio loss associated with x and y. In the previous session, we gave a brief introduction of VAR and CVAR definition. Here, we give a more formal mathematical definition. First, the probability of the portfolio loss f of x and y less than or equal to a threshold 0 is given by the first formula of the slide. As a function of 0 for fixed x, 0 is given. The integral is actually the CDF for the loss associated with x. Then, for the alpha VAR, it is the minimum 0 such that the CDF of 0 is greater than alpha. For alpha CVAR, since the probability of f of x and y greater than alpha VAR is 1 minus alpha, so find alpha of x comes out as the conditional expectation representation. The last function f alpha is the combination of alpha VAR and alpha CVAR. This is the key formula for the optimization problem. In this session, we will briefly talk about the theoretical part. We will briefly introduce the 4 theorems used in the paper, some techniques, and key results to formulate the problem. The first one is Theorem 1. It mainly talks about that the alpha CVAR can be determined by the minimum f alpha with respect to 0, and the alpha VAR is given by the left endpoint of a set consisting all the values of 0 for which f alpha is minimum. Theorem 2 showed us that 2 things. 1. Minimizing phi alpha of x is equivalent to minimizing f alpha with respect to x and 0. In particular, the minimization of f alpha produces a pair of solution x star and 0 star. Such x star minimizes the alpha CVAR and 0 star gives the corresponding alpha VAR. Furthermore, if f of x and y is convex with respect to x, then f alpha is convex with respect to x and 0, and phi alpha of x is convex with respect to x. If the constraints are such that x is convex set, the joint minimization is an instance of convex programming. Theorem 3 showed us that the problem 1, 2, and 3 generate the same efficient frontier if phi of x is convex, R of x, which is the reward function, is concave, and the set x is convex. Theorem 4 showed us that the minimization problems of 4 and 5 are equivalent in the sense that their objectives achieve the same minimum values. In particular, when the interval A alpha of x star reduces to a single point, the minimization of negative R of x over x and zeta produces a pair of x star and zeta star such that x star maximizes the return and zeta star gives the corresponding alpha VAR. Then we introduce some techniques. Firstly, the f alpha can be approximated as f alpha tilde. The integral sign in f alpha is replaced by summation sign to become f alpha tilde, and pi j are the probabilities of scenarios yj. If the loss function of f of x and y is linear with respect to x, then f alpha tilde is convex and piecewise linear. Secondly, we introduce the dummy variable technique often used in solving linear programming. The f alpha tilde can be replaced by the formula zeta plus 1 over 1 minus alpha times summation pi j zj, and with the two constraints on the slide. Here is the key result. Theorem 1 told us that CVAR can be determined by minimizing f alpha with respect to zeta. Theorem 2 told us that it isn't necessary to work directly with phi alpha of x to find the x to minimize alpha CVAR, as it may be hard to do so because alpha VAR may have troublesome mathematical properties. Instead, we can work on a far simpler expression, f alpha, with its convexity with respect to zeta and even with respect to x and zeta. In traditional approach, we minimize CVAR subject to a target return. Now, we maximize the reward subject to CVAR constraints. By theorem 2, if f of x and y is linear with respect to x, then phi alpha of x is convex with respect to x. And also, we suppose R of x is linear and the constraints are linear. So, the conditions of theorem 3 satisfied. By theorem 3, as shown in the slide, these two problems generate the same efficient frontier. That means maximizing reward under a CVAR constraints generates the same efficient frontier as the minimization of CVAR under a constraint on the reward. By theorem 4, these two problems are equivalent. By discretization, f alpha in the constraint can be approximated by f alpha tilde. And finally, by linearization, the problem further reformulated in a problem in the form of a proper linear programming problem. In this session, we include the formulated model with additional constraints. The first part is the notation part. There are n instruments with one risk-free asset inside and j historical returns for each instrument. X0 is the initial position of the instruments. X is the optimal position of the instruments. Q is the initial price for the instruments. Y is the scenario-dependent prices for the instruments at the end of period. F is the loss function over the period. And R is the reward function. The second part is the CVAR constraints. Phi alpha of x is the alpha CVAR risk function. Omega is the percentage of the initial portfolio value allowed for risk exposure. Using the key result from the previous part, the risk constraint can be transformed into the sets of constraints given on the slides. The third part is including transaction cost with constraint. CI is the transaction cost of instrument I, expressed in percentage and with transaction cost of cash 0. To remove the absolute sign, it can be reformulated as the set of constraints given in the lower half of the slide. UI plus and UI minus represents the positive position change and negative position change respectively. The fourth part is the value constraint. The model does not allow for an instrument I to constitute more than a given percent nu I of the total portfolio value. The fifth part are the constraints of the change in individual positions and bound on positions. For position changes, we can determine the lower limit of negative change and upper limit of positive change. For position bounded, we can define the lower limits and upper limits of position as well. Here is the summary of the model. It includes every constraint as discussed before. It is a linear programming problem with 3n plus j plus 1 variables and 5n plus 2j plus 2 constraints. The first 3 lines basically follow from the key result of the theorem part. The rest of the lines are just combined all the constraints in this session. The final part is the scenario generation procedure. We generate scenario-dependent price Yij for instrument I for j historical ratio as follows. The initial price times the historical ratio. Say, for a 10 days period, we use the price of the 10th day over the first day price times the initial price as the first scenario-dependent price. The price of 11th day over the price of the second day times the initial price as the second scenario-dependent price, and so on. We assume all scenarios are equally probable. In this session, we have a case study in SMP 100. The first part is the background. We use R as programming environment. We use the package RGLPK, QuadProg, and Matrix. We use the data from Wharton's research data series. The period of the data is from 1st of July 1997 to 8th of July 1999. We have 94 stocks in the SMP 100 as of the 1st of September 1999 and cash as our instruments because there were not sufficient data for 6 stocks. The prices are adjusted by having each raw price divided by its cumulative adjustment factor from WRDS. The date of investment is the 9th of July 1999. Now we are going to talk about the parameters in the model. There are 95 instruments, 500 historical returns, the initial portfolio with $1 cash only, the optimization period for 10 days, no short sales allowed, and no constraint in position change. Each instrument value is not allowed for more than 20% of the portfolio value. The return for cash is 0.16% over 10 days. Here is the result. Figure 1 is the efficient frontier with CVAR constraints omega. We obtain the efficient frontier by adjusting omega and solve the LP to give an optimal X. Then the return is calculated. We have 3 alpha CVAR, 90% CVAR, 95% CVAR, and 99% CVAR. Here are the observations. First, the higher the risk tolerance level omega, the higher expected returns. Second, there exists some omega such that the expected return cannot go higher for every alpha. In our case, the maximum return is 2.667% over 2 weeks. Thirdly, for very small omega, there is no feasible solution of the LP. Table 1 is the portfolio configuration with alpha equals to 0.9. In the table, we solve the linear programming problem with different risk tolerance level omega ranging from 0.02 to 0.1. For each portfolio, we showed the expected return, standard deviation, CVAR, and detailed portfolio weight. The stocks not included in the table means that the portfolio weight of all cases is 0. Here are the observations. For higher risk levels of allowed risk, the number of the instruments in the portfolio reduces in order to get a higher return. Second, for lower levels of allowed risk, the optimal portfolio includes 15 assets, including the risk-free cash. This confirms the well-known fact, diversifying the portfolio to reduce risk. Figure 2 is the efficient frontier with transaction costs included. The alpha in this case is set to 0.9. Transaction costs in the figure are 0%, 0.25%, and 1%. Here are the observations. Transaction cost needs to be included when implementing an active strategy. The transaction costs are non-linearly lower the expected return. Also, Since transaction costs are incorporated into the optimization problem, they also affect the choice of stocks. Now we have a comparison with mean variance portfolio optimization. The difference between CVAR and MV is consideration of tail. CVAR aims at reshaping one tail of the loss distribution, but not the opposite tail for profit. MV incorporates information from both tails. For the mean variance portfolio, we use similar technique as scenario input for generating the mean factor and covariance matrix. Now we have figure 3 and figure 4. Both are efficient frontier with CVAR as x-axis, while figure 3 includes the 95% CVAR and figure 4 includes 99% CVAR. In the figure, we have a comparison over CVAR optimal portfolio and MV portfolio. Here are the observations. First, for a given return, the MV optimal portfolio has a higher CVAR risk level than the CVAR optimal portfolio. Second, the discrepancy between CVAR and MV solutions is higher for the higher alpha. Now we have figure 5 and figure 6. Both are efficient frontier with standard deviation as x-axis, while figure 5 includes the 95% CVAR and figure 6 includes the 99% CVAR. In the figure, we have a comparison over CVAR optimal portfolio and MV portfolio. Here are the observations. First, for a given return, the CVAR optimal portfolio has a higher standard deviation risk level than the MV optimal portfolio. Second, the discrepancy between CVAR and MV solutions is higher for the higher alpha. Here is the conclusion from the result. The difference is not very significant between MV and CVAR. We have relatively close graphs indicating that MV optimal is near optimal in CVAR sense and vice versa. It suggests that the historical returns may be close to normal distribution. We are going to apply the methodologies on Hong Kong market. We have 4 optimization objective functions, namely variance, mean absolute deviation, systematic risk, and 95% CVAR, all subject to a target return and portfolio weight constraints. We want to compare the portfolio weights under various risk measures and their performance with benchmark, including equal-weighted portfolio and HSI. We use HSI constituents as of early 2010 for portfolio constructions and HSI index as the factor for single-factor model. We get the data from Yahoo Finance. We select the data from January 2010 and December 2014 for portfolio construction and from January 2015 and December 2015 for portfolio performance evaluation. Note that for any stock that did not trade at a particular day, we deleted all prices on that day. To set a target return, we cannot fix a target return over different horizons due to the volatility of the market. For example, a 4% annual target return may not be achievable in some periods without short sell. In this part, the target return is set as the average HSI return over the sample period. Also, there is no short sell of each stock, and there is an upper constraint 20% for each weight of the stock. We set this constraint because some of the HSI constituents may experience steady growth over the sample period, and this causes the weight of the stock very heavy. These are our settings on our portfolio optimization problem. Here is our optimization result for portfolio configuration. We can see that 0002.hk, 0006.hk, 0011.hk, and 0066.hk have heavy weights among all portfolios. There is actually no significant difference among those portfolios. We cannot reject the hypothesis that the returns are multivariate normal as from the paper. if they, as from the paper, if they are following multivariate normal, then MV and MAD should be largely the same. Here is our result for the performance of those portfolios. First, we can observe that HSI are equal-weighted, and equal-weighted portfolios are more volatile than the 4 portfolios because the benchmark performed better than all the portfolios in upmarket and worse than all the portfolios in downmarket. Second, we observe the trend are basically the same for all the portfolios and the benchmark. Thirdly, to our surprise, when the benchmark is suffering a loss towards the end of the year, those 4 portfolios, in fact, are making profits.
In this part, we aim to study the transaction costs for different risk models. Different rebalancing frequency and holding period will be used for our analysis. Before we move on, we define some of the terms we will use in the coming slides. First, we define rebalancing as the process of realigning the weighting of assets. It means that after some time, you have to change your portfolio weighting because of stock price movement or market structural changes. Rebalancing refers to any changes to the portfolio weighting. Next, holding period refers to the length of data used to form portfolio. Note that rebalancing frequency is not equal to the holding period, and we provide a simple hypothetical example in the next few slides. Suppose we have 12 months of data, and we define our holding period to be 3 months and rebalancing frequency of 1 month. To simplify the issue, we assume that there are only a total of 3 stocks in the universe. We first look at how our portfolio is formed. Since our holding period is 3 months, it means that we will use the first 3 months of data to construct our portfolio. We will use the first 3 months of stock data as historical data and construct our first portfolio at time 3. How long will we hold this portfolio? It depends on the rebalancing frequency. Since the rebalancing frequency is 1 month, we will rebalance our portfolio at time 4. The new portfolio will be constructed using 3 months data, from time 1 to time 4. Therefore, portfolio 1 will be held from time 3 to time 4, and portfolio 2 will be held from time 4 to time 5. This slide shows that how we will construct the portfolio and how often we will rebalance our portfolio based on the 2 parameters. Then we will show you how we can calculate the portfolio variation. Suppose the stock holding of each portfolio is specified in the table. We define the stock variation from one period to another as the sum of absolute changes in weightings. For example, for time 1 to time 2, the stock variation is the sum of absolute changes in stock weights from time 1 to time 2. Stock variation of 0.4 here means that 40% of our capital is changed from time 1 to time 2. We have to reduce the holdings for some of the stocks while increasing the others, and the total changes is 40% of the capital. Then we define the portfolio variation as the sum of stock variation over our investment period. Suppose in our investment period, we have a total of 4 portfolios formed based on the rolling historical data. Then the portfolio variation is calculated as the sum of stock variation from one period to another. Here, portfolio variation of 1.8 means that over our investment period, the total changes in stock weighting is 180% of our capital. It does not mean that we need to borrow any money or do any leverage. For example, if we originally hold one stock and in the next period we sell it and buy another stock, it will result in 200% of portfolio variation. Stock variation here measures the total change in weight from one time point to another. It is directly related to the transaction cost since any buy or sell actions result in transaction cost. Larger stock variation means a higher transaction cost for a single period. For portfolio variation, it is very similar to stock variation, except that portfolio variation measures the change in weight over the whole investment period. It measures the amount of transaction costs required to meet the target return, risk function minimization, holding period, and rebalancing frequency. Higher portfolio variation means a higher overall transaction cost for the investment period. To study the portfolio variation for different risk measures, rebalancing frequency, and holding period, we use HSI constituents as of early 2010 for the portfolio construction. All the data are adjusted closing price from Yahoo Finance and can be downloaded through T-Series package in R. We use 6 years of data for our analysis, and we use the HSI index as the factor for the single factor model. After data cleaning, we obtain a total of 41 stocks with around 1,500 data points each. To simplify our calculation, we use the common divisors as the rebalancing frequency or holding period. For example, we use 20 data points to represent 1 month data, 40 data points to represent 2 months data, and etc. The number in brackets represents the number of data points used to represent the period. Here, we show the results of rebalancing every 3 months and holding period of 1 year. There is no particular pattern we can observe except that the portfolio variation under the mean absolute deviation model is in general smaller than the other models. We think it is reasonable since the mean absolute deviation model accounts for the cutoff effect as mentioned before. The mean absolute deviation model holds less stock than the other models, and it results in smaller portfolio variation. The coming 4 slides shows the results of portfolio variation under different holding period and different rebalancing frequency under various risk measures. There are 2 things we can observe in these 4 tables. First, portfolio variation decreases with holding period. It means that longer holding period results in lower stock variation. It is reasonable since longer holding period means more overlapping data. Second, the portfolio variation also decreases with the rebalancing frequency. Rebalancing more frequently means that more overlapping data, and it leads to a lower portfolio variation. To conclude today's presentation, we try to answer the questions raised in the introductory session. Is there any difference in portfolio construction under different risk measures? Theoretically, the 5 risk measures should give the same optimal portfolio if the underlying stock returns follow multivariate normal distribution. In our study, there are some differences in the portfolio weights, but the difference is not significant, and so we may argue that the data are possibly close to normal distribution, subject to some measurement errors. We cannot conclude which risk measure is the best one for an individual investor, and the similarity of solutions should not be misleading in deciding the best one. We believe that the risk measure that is most suitable for an individual investor depends on the risk preference of the investor. For example, if the investor cares more about the tail of the loss, he should consider using CVAR as the risk measure for his investment. On the other hand,
If the investor wants to eliminate the market movement volatility and believes his stock portfolio can outperform the market in the long run, he may want to use the single factor model and hedge his residual systematic risk against the market index. Overall, we have tested the performance of the risk models against the market index or the equal-weighted portfolio, and we found that the portfolios under all the 5 risk measures outperformed the benchmark by a significant margin. This is the end of our presentation, and interested readers may refer to the references in the next slides for further readings.